Now we speak with Caleb Alimi, he's the chief dealer at Providence Bank, on what this means for yields, investor strategy, and market liquidity. Good afternoon, Caleb. It's good to have you join us.
Good afternoon, Will. Thank you for having me.
Caleb, what does this fresh 850 billion naira T-bills offer mean for liquidity in the financial system?
Well, the financial system, your interbank market is extremely liquid at this time, with liquidity almost touching 7 trillion. So 850 billion total offer for investors is sort of like a drop in the ocean at the moment. However, we think that given the current overheads or current headwinds that the economy has experienced from the international space affecting the local markets, we think yields may remain around, the 16.7 handle. We think it's going to close. We think the auction is going to close just under 17%, largely because of the headwinds that we've seen. So we expect it to stay between 16.7 and say 16.9% at this auction. So the supply is good. However, there's another auction next week. So there's, back-to-back NTB auctions of supply, but the market is really liquid.
Okay.
And this 850 is not enough to, assimilate all of the demand in the market. We'll probably see another subscription, topping 3 trillion or thereabouts.
Okay, now let's. Do you expect demand to be strongest, say, for the longer dated 364-day bills again, as we saw, and what are the reasons for this?
Yes, we always have the strongest end of the paper, which is the one-year paper. That always has the highest subscriptions, and that will continue to happen largely because investors are looking for stable returns over a medium to long term. So if you hold the paper for just 90 days, you run a reinvestment risk, 90 days from now. If you hold for just 180 days, you hold a reinvestment risk 6 months from now. But if you hold for 1 year, that's where you find, get the best value, so to say. And then your investment risk is, 1 year down the line. So we'll continue to see more demand on that 1 year paper.
So what does this back-to-back supply from the CBN, what does it mean? What signal do you think it's sending to investors?
Well, the signal is simple. There's been a calendar that tells us this is how they're going to borrow. We also know from the offshoot of the deficit budget for this year, we know they're going to have to borrow a lot, especially as we go further down the year as the elections, pre-elections preparations begin to heat up. So definitely this tells us they want to borrow. They need to fund the budget, and so this is expected.
Okay, so looking at, I just have a report now that just kind of compares what we saw last year in the first 2 months of 2025 and what we're seeing in 2026. We're seeing that drop in NTB subscription because in the first 2 months, that's January to February 2026, we had about subscription dropped to about 6.13 trillion naira, down from 9.68 trillion naira that we saw in the same period in 2025. And this amount keeps decreasing in terms of the offer and the allotment that the CBN is also making to the market. Why do you think we have this continued drop? Is this a lack of investor appetite for government bills, for government instruments, or is it the yields that are impacting this supply in the market?
Thank you, Will. You've already answered the question. I was going to say it's just an interest rate play. This time last year, what were interest rates doing? And then 1 year after, what are interest rates doing? Yields have significantly dropped from where they started off this time last year, and that, informs the interest. That's one. Secondly, we can also say, aside the drop in interest rates, what the capital market is doing on the other side is also giving investors a lot of confidence, and we're seeing capital allocation move to the capital markets. Throughout last year, the capital market did about 36%, and just in this first quarter, in the last few months, it's done over 23% already. So, if investors are moving, allocating more capital to the equities market, we can understand why, and we can also see they're getting lower returns on the money market space. So why not just go to the capital market and get a piece of that pie?
So, do you see? Does it kind of like tell us or signal where the CBN is actually, what signal is actually thinking about? The CBN is actually thinking of in terms of interest rates, liquidity. What does it signal? What does it tell us about the CBN's thoughts right now?
Yeah, so if we did not experience the headwinds from the current US-Iran tension, we expected interest rates to continue to drop. We expected a rate cut at the February Monetary Policy Committee, a bigger rate cut than the 50 basis points rate cut we saw. Inflation has, also moderated aggressively. We can say we're in a period of disinflation. And so all of those parameters just give the central bank enough confidence to actually begin to cut interest rates and bring interest rates down. The only spanner in the works has been the US-Iran tension and the impact that it has had, spillover into the local economy. So aside that, what we've expected is for interest rates to continue to decline and for yields to continue to decline, for the central bank to also continue to reduce the monetary policy rate. So all of that points to interest rates trending down, the fundamentals back it, inflation trending down backs it, the currency strengthening backs it, the reserves increasing backs it. So many things back that up, why we should have reduced interest rates in the economy. But just this headwind from the US-Iran tension is what has sort of like made the CBN more cautious. And that's it.
Okay, so talking about the US-Iran tensions and the conflict that's ongoing, if this war persists, Caleb, how exposed is Nigeria?
Well, I would say, without saying how exposed it is for Nigeria, I would say we have very few positives that we can take from it all. The war is going to serve us in positive terms. Why? Because the major supply route for oil, globally is going to be affected. And that means Nigerian oil supply, Nigerian crude supply becomes more valuable, right? Aside the fact that it could have inflationary pressures on the local price of PMS in the economy, it's a positive for Nigeria's earnings. Nigeria may not need to borrow as much as it, planned to borrow before if oil prices stay above $90 a barrel. With the budget was cut around $65 a barrel, so there's already a $25 a barrel gain. If the war persists, which means oil can top $100 a barrel, which means there's improved revenue for Nigeria. So improved revenue means there could be less borrowing. However, the impact could be felt on the exchange rate, which we saw, when the war started. There will be flights to safety by foreign portfolio investors, which means they want to, go to the safest, quote-unquote, safe currencies, which is dollar, for example. They want to exit emerging markets and go to developed markets or stable markets, dollar in this case. So what we would have seen is, the impact on the currency. Is Nigeria prepared to handle that? Can Nigeria defend, its current currency and all of that? Yes, the central bank, continue to publish data that shows that gross reserves is growing. The bullion portion of that gross reserves is also growing. So there's so many positives for Nigeria. We can wither, any exposure or any storm that may come from that, from the fallout of that war, especially because we're an oil-based country, and that is what's going to pay us, or just going to serve us positively.
Thank you so much, Caleb Alimi, for your perspective. Caleb Alimi, Chief Dealer at Providus Bank.
Thank you for your time.